For funding with life or disability insurance, there are 3 different options, and there's a little more of a breakdown of each option also. So disability insurance, key person replacement. This is a monthly increment or lump sum payment to the business owner after the waiting period has been fulfilled for disability. For the life insurance, that's for the death benefit. So for term, there's 10, 15, 20, and 30 year. And then we have the permanent options with Principal. Those are all universal life products. And I'll get into what that looks like with each of these options for the life insurance. Going back to the example I gave earlier about the business owner that had it was like the 6 million coverage and more. So in this case, here was our death benefits that I suggested. And then as you can see, this is the breakdown of the annual premium based on the duration selected. So like I was saying before, this can be catered to your client's needs, to their budget, or their risk level. And so in this case, we can see the difference between a 10-year and 30-year is about $15,000 in premium. So they have the longer protection, but higher premium to have a 30-year plan. And then a 10-year term plan would be the least expensive option for this type of insurance. We have these 4 funding options. This chart, as you can see, it says the protection on the left all the way over to accumulation. So all of these products have a protection base. It's just what are you getting in addition to the protection? So the term, you're only getting the death benefit for the set amount of time that is in the policy. If we go over to the UL, this is our cheapest permanent policy. It gives long-time guarantees. It has some cash value, but it would be the lowest amount of cash value compared to these other plans. Doing an indexed universal life plan, we have the downside protection. It can only go down to 0%, but there's the upside of it being invested in index funds. So we could see growth anywhere from 6 to 11% of a return on the investment. And then for variable, this has the insurance aspect, but it's also an investment vehicle where they're able to select whatever funds they want to be invested in. It can be totally personalized if they would like to be able to get a good return and have the death benefit protection. So why consider using a permanent life policy over a term policy for key person? By having the policy cash value, there's that immediate liquidity. It's an asset on the balance sheet, and it can be used for a number of business needs. And it's all available without the death having to happen. This is just the fund of money that is available within the insurance policy to take distributions from. Looking at life insurance versus other investment options, the benefit of using life insurance is the contributions are after tax. There's no tax on the growth and there's no tax when withdrawn compared to doing something like a mutual fund or a retirement account where there's the tax as it grows or tax when income is taken out. The life insurance can be advantageous tax-wise. This example is an illustration using indexed universal life insurance. So this one I modeled based on the business owner output that I showed earlier. So in this case, it was for the $6 million death benefit. We wanted that as a minimum. And for this one, I set it as putting $75,000 into the policy every year until age 70. So that's 20 years of paying this premium amount. By using the IUL, we're able to see that there's this accumulated value. So by doing this, after year 10, they have access to $362,410 that could be used for distributions. After year 15, that's almost $800,000. And in year 20, that's $1.3 million. So this will continue to grow as the policy goes on. This snippet is up until the retirement, or they might exit the business. So by having that 1.3 million available, that could be used to fund the buyout or for other business needs. In the case of an owner, it's likely that they would let the business continue to keep the insurance on them after they've stopped working at the company. So this jumps ahead 5 years. I just fit it on the screen, but this goes to age 76. So they stopped paying the premiums at age 70, but kept the policy in place. So they're not putting money into it anymore, but it's continuing to grow. So there's still that $6 million death benefit. In this case, it lasts to about age 90. And there's the accumulated value that continues to go up to, I think the highest is this 1,866,000 when that's at age 83. And then it starts to decline because it tends to decline as they get older. But by having access to this accumulated value for this much longer after they exit the business and then access to the death benefit, it could be really valuable to them to use the permanent insurance versus just having done a 20-year term. So I mentioned this before, it can be used for the succession planning, funding the buy-sell. We can also use that cash value for deferred compensation plans or additional retirement income for the owner. The tax implications of a business doing this type of plan are the premiums are paid with after-tax dollars. It is not tax deductible as a business expense, which this is something that I find is important to clarify. People don't always understand this and think it might be. But because the business is the beneficiary, they're getting the tax-free death benefit, it cannot be tax deductible for them. The cash value growth within the policy is tax deferred, and the company receives the death benefit proceeds income tax-free. So lastly, this is just a case study. This is Mark, who is a business owner, and he has a sales team that's very important to the business. His top salesperson is Renee, who brings in more than 35% of the total annual sales revenue. He identified Renee as a critical employee, that the company would be in jeopardy if something were to happen to her. So he works with his financial advisor to find a solution. By using our key person calculator, meeting with the financial professional to talk through their needs, their budgets, and just how this could work for them, they identified that they needed a $700,000 death benefit, and then they also did a $250,000 disability key person policy. And this was all based on the size of the organization, her job title and annual income, and how difficult it would be to replace her. So they had the options for the kind of life insurance that they would do. They could do the 20-year term to cover just until she retires, which was to be the most, the cheapest option that they could do, or they could do the permanent insurance to help cover other company expenses. In this case, they did end up going with the 20-year term because they just didn't have the budget to do permanent insurance at this time.